Yeah, we are talking about the U.S. market update on Friday the 28th. So, welcome to everyone. By the way, before we go too much further, don't forget to hit that like button, or better yet, hit subscribe. You'll be notified immediately when one of these videos is posted. We're on the run to 40,000 subscribers. And remember, all you have to do is post a comment, and you're registered for 4 free memberships that we're going to be giving away to our alert service at ewotrader.com. So you just leave a comment and you're entered. So help us get to that 40,000 level. All right, let's take a look at the market. So looking at the S&P, yesterday was a really interesting day. Last night we had our insiders meeting for our alert subscribers at ewotrader.com. We talked about, well, we had a big outside day, and that's where we opened at the high of the day and we closed at the low of the day. We had a lot of news this week that played into that, I think. The Fed announcement, I felt that Chairman Powell was maybe a little less hawkish than he's been, but I don't want to say he was dovish. I think he was somewhere in between. And boy, the market was going back and forth. It seemed like with every comment that he was making in his conference afterwards, after the announcement was made. And then the market rolled over, and I think it rolled over when he made a comment on I don't think that we're going to get the inflation target down to 2% until 2025. And that was something that seemed to maybe spook the market. The market seemed excited about how he was saying, we're just going to go meeting to meeting. He didn't commit to that second rate hike like he did the last meeting. So that's where I felt he was a little less hawkish, but they did raise 25 basis points, and we had that little bit of a rollover, and then we had the outside bar. What that means is that the high of the day yesterday exceeded the high of the previous day, and the low of the day exceeded the low of the previous day. That's why it's known as an outside day. What does that mean? Well, it just means that something's likely to happen in the markets. But as with triangles, where you don't know which direction it's going to break, with an outside bar, you don't know if that means it's bullish or bearish. Now, if we looked at the fact that we opened at the high and closed at the low, I think we would have kind of leaned a little bit bearish, but that isn't how things worked out because we had the PCE deflator come out this morning, and that's the Fed's favorite indicator for inflation, and it was a little lower than expected, but let's be specific here. It still came in at 4.1%. The expectation was 4.2. So, they're kind of splitting hairs here by saying, oh, it was better than expected. But the market seemed to like it, and we took off today, finishing to the upside. But then when you look, we have an inside bar today. So that means that the high of the day was lower than the high of yesterday, and the low of the day was higher than the low of yesterday. So we went directly from an outside bar to an inside bar. So with those two indicators back to back, I would say we're probably going to see some volatility next week. Which direction? Again, we don't know, but it looks like we're going to make some sort of directional move. Now, I still have the zigzag pattern on the screen here. As you know, we did hit that level that we had been talking about for quite some time at 436 a while back, and now we're looking to see, do we make the next move to 465, as we've been talking about over the past week or so. That's where the 100% extension is, but that B wave correction is only at 38.2, which means a 61.8% extension. So then when you get there, that means that the zigzag has done what it's supposed to do. It's fulfilled its forecast. But there are times when you get an extended C wave. So do we go to the 100% level? We like to look at our confirming indicators, and that's our DMI is our primary one. We have other ones as well that we educate people on at our website, ewotrader.com. But here you can see the ADX, which measures the strength of the move. That doesn't mean that we're in an uptrend. The ADX would be moving up even if we had a strong move to the downside. So it's an indicator of strength. So it's telling you that this move has some strength, which means that there is a possibility that we do go up and hit that 100% extension. At least the DMI seems supportive of that kind of a move. So that's kind of the main part of what's going on with the markets. I do always like to show you the 10-year, as you know, and that was a little bit spooky yesterday as we've gone back above 4%. If you've been watching this for weeks, you know that we've been talking about this trading range between 34 and 40. That's the sweet spot for the tech stocks. And then anything above 40 basically is above 4% on the 10-year. Starts to get a little rough for the tech stocks. We had a break attempt there with no follow through in early July. And then we tried again yesterday, but no follow through. we didn't back off too much, but we did get back below that 4% level, and that seemed to be enough for big tech today. They had a pretty nice day moving to the upside. So as long as we can stay below this 4%, but yeah, we're still kind of spooky close. So I think we have to watch that moving into next week. We are in a 5-wave to the upside pattern on the 10-year. And so if rates do begin to continue to move to the upside, that will be problematic for the Qs and big tech. Taking a look at the dollar. The dollar, just the level we've been talking about for weeks and weeks here at 101. That's support resistance, and we're just right there closing at, well, I know that trades 24, but we get these closing bars just like we do with the futures for end-of-day charting services such as this one at hubb.com. If you're interested in learning more about this software program, I think it's the best Elliott Wave software that exists. So we're right around 101.60, so we're just above that level. And we've been talking about this correlation on our Tuesday night TradeFinders for the past few weeks now, because people ask, we do TradeFinder every Tuesday night, by the way, at 9 p.m. Eastern time. We talk the markets, we look for trade ideas, and we do a Q&A at the end. And it's free. You can register at our website at ewotrader.com. You can see on your screen right now exactly how to register. Love to have you. Again, it's free. And a lot of the questions that have been coming up over the past few weeks have had to do with the metals. People are itching, as am I, to get into either SLV or GLD, whatever your favorite ETF is. And we need that dollar to get back below 101. We broke it, and I resisted this move. We've chatted about that during TradeFinder the past couple of weeks. It was too vertical. That move was just too straight down. I don't like vertical moves. You all know that. You've been watching, and said at least we should come back up and test 101, which we have, but we haven't turned back around yet. It looked like we were about to, and then we're back above 101. And so if we look at SLV, which is what I like to look at, I feel like it's the big brother now to GLD when it used to be the inverse. And you can see that we just are hanging in there. We don't quite have the signal. This Elliott wave pattern has been disqualified because that wave 4 was too low. So we take that off, and we're looking to see, are we in the next impulse move? We do have a potential zigzag pattern being set up here. And if we hold there right at that 38.2% level, that would bring the SLV up to the 61.8, exactly what we were just looking at on the SPY chart. And that would bring us above 23, which is, I think, where we need to get on the SLV. So for me, it's just a wait and see. And if the dollar takes off and moves back to the upside, then we're not going to catch a bid in the metals. But if the dollar does break back down and heads lower, which the 5-wave pattern on the dollar suggests, then we may get the bid and this follow through here with the C wave move up to that 61.8% level. And if we can get that far, again, talking about the extension level like we did with the SPY, I think there's a pretty good chance that we probably have an extended C wave here. So a long-awaited bid would be right there. And notice when we had that big vertical move down in the dollar, there's the vertical move up in SLV, and I like that either. And this is why, because vertical moves get retraced. It retraced on the dollar and it retraced on SLV. That's why we talk about these rules here, because they're important. And so you need to pay attention to them. So you don't want to get sucked in. The market gives you these head fakes all the time. So let's wait, be patient. And if the dollar breaks down, we'll get our chance to go long on the metals. Looking at the rest of our markets, we got the DIA, and the wave 5 has just been right smack here in the middle of the tap box. Again, the best Elliott wave software that I believe exists at hubb.com here is programmed exactly to the algorithm as Ralph Nelson Elliott himself wrote it. So we're just peppering this tap box, which stands for time and price projection. So we're resting here, which is, I think, healthy because we had kind of a pretty strong move, almost too vertical, up into that wave 5. But the consolidation is warranted to see if perhaps we can get a continuation. So we're certainly in wait and see mode because, as you know, the way 5-wave patterns work is if the 5-wave ends, which it might be doing, you retrace back to the previous 4, which would be a move heading back down towards this previous 4 level. Or we can extend again, just like we've been talking about. But right now, we're just going through consolidation, so we don't really have much of a signal one way or the other. We're still above the 10-day moving average, so at least stay cautiously optimistic, which is the terms that I've been using for the last few weeks, as you know, for now. And then here's the Qs. And, for what happened yesterday, not too bad. There's the down day because the 10-year got above 4%. And when it does that, again, as I said, the tech stocks struggle. So a down day yesterday, but bouncing right back is all we need to do is get below 4%. It looks like a really strong wave 3 move here. So let's bring the DMI on. Now, the issue that I have here with the Qs, which is a little concerning, number one, that TNX is just barely under 4%. But notice in the last part of this wave 3 run that the ADX has been moving down. So we've made lower highs here. It trends just like any other indicator does. So what it's telling us is this last part of this move in the wave 3 has been nowhere near as strong as this first part of the wave 3 move was, where we had the ADX moving up. So in that part, it was moving up. Very strong move. We've continued to the upside, but this is kind of giving us an early signal of we're running out of steam here. So I think we want to be real careful to watch the 10-year and the Qs, the tech stocks. They look a little bit tired to me anyway with the big runs that they've had. We take a look at the Russell. The IWM looks almost exactly like the DIA with a big move to the upside and just smashing again that tap box. So, if you're not a believer in Elliott wave, what do I have to show you with all these indications here, how it's been nailing the markets? The zigzag patterns, my favorite directional pattern. It's only 3 waves instead of these 5 waves, so you get your results a bit quicker. But it's just been so spot on with where we are in the markets. And then you look at the IWM. We've been talking about the 170 to 190 level. We did get above 190, but we're at those previous highs from back there at the end of January and early February. And here's 190 that we haven't really tested yet since we broke it. So the trading range has been 170 to 190, except for that brief period where we kind of consolidated between 170 and 180. And then we broke out of that. See how we came back and tested 180? That's what I'm talking about. We broke above 190, and we haven't come back down to have that test at 190 like we did when we broke the 180 level. So I think a little bit of caution here on the IWM. So the markets are moving to the upside. I just think, we got to proceed with caution here. Bitcoin. Interesting now because, as you know, we're kind of in that cycle, about 9 months to go before the halving, which normally is when Bitcoin takes off. At least it has every other time. But a little bit of a pullback here. To me, that's okay because, as you've heard me say, I didn't like this vertical move. Same old thing we've been talking about. Vertical moves get retraced. So we've had a bit of retracement here. Same thing that we were talking about way back here in March. I didn't like that vertical move. And then we came back and retraced it. We've moved vertically again, but we've retraced it now. We're at a key level because we're right at the 50-day moving average. The royal blue lines, the 50-day moving average. So that's going to be really key to see if we can hold that level. If we can stay here at 29,000 and hold the 50-day moving average, perhaps we're getting ready for that next run. But if we give up the 50-day moving average, I think we could be headed lower to possibly at least 27,000. And I wouldn't be surprised if we even came all the way down here and tested 25 again. But we've tried to hold support at 27 if we break 29. So pretty important to watch this 50-day moving average with Bitcoin. You can see the last 4 days is basically on the lows, been right there at the 50-day moving average. Coinbase, everybody's been asking about Coinbase. That's a common one that comes up on Tuesday night's TradeFinders as well. And we had this big vertical move here that occurred when kind of the government backed off with all the regulatory stuff, and it gave Coin the opportunity to break above 80, which we had been talking about, that it just couldn't see going long Coinbase until it broke above 80. Well, I didn't necessarily think it was going to break it like that and go so vertically to the upside. That was concerning. So this pullback, I think, is great. It's warranted. Even if we come back down and test the 80 level, there's the royal blue line, there's the 50-day moving average. Even if we come all the way down here and test 80, I think that's still okay. We got a little doji here on the inside day. So likely something getting ready to happen with Coinbase next week along with the markets. But if we come down here, if you're long Coinbase and you didn't get out on this big move, you perhaps can add here if you come down. I think coming down to test 80 would be a gift. We may not come down that far. We may hold right in this area, but we are below the 10-day moving average. So that's something to be concerned about as we move into next week. But all in all, bullish, constructive, I think, and some give back from that vertical move was really necessary. All right, we're in the middle of earnings season. And this week and next week, the majority of the S&P is going to report. Now, historically, when we look at the S&P earnings, you can see the chart on your screen now. You can see there's a little bit of a rollover there. So are we getting tired? Again, I think a lot of people felt like earnings were going to be a little worse, myself included, this quarter with the inflationary pressures, especially with the fact that we still have the inversion on the yield curve. So far, hasn't been that bad. Earnings have been pretty good. So let's talk about a few stocks here of interest that had earnings this week. And Tesla, everybody wants to know about that. We get constant questions about Tesla. And I just want to caution everyone, Elon warned us. He literally warned us on the earnings call where he's talking about how the production numbers for the next quarter are not going to be as good. You know, they beat them last quarter. They had better production numbers than was expected. They're going to be closing down some plants. They're going to be retooling the plants, upgrading some of their equipment, etc. So he's already told us that the numbers aren't going to be as good. And then we had this big run here to the upside, which was pricing in all of the other EVs are going to be using Tesla's charging stations, etc. So my concern here is where's the catalyst to move Tesla higher near term? You heard us talking about when we got up to 280 that I couldn't imagine Tesla getting this far, and that was when we had this gap up here without at least hitting 300. Well, we got to 299. What was I? 299.29. That's pretty darn close to the 300 level, and then we've backed off. And then they had the earnings report, and I just don't see where the catalyst is near term. So if you're long Tesla, which I know most of you are because you leave your comments all the time about Tesla, if I say anything negative, you get upset. I'm not trying to be negative at all. I'm just saying a little bit of caution here. We need to hold 260. If you can hold 260 on Tesla, then I think we stay long. But if we break 260 on Tesla, then I think we have to look at this gap that hasn't been filled yet. And potentially coming all the way down here to where the support would be at 220. So a minor bit of support here around 235, filling that gap. If we come down that far, I feel like we come test 220. And if the market weakens at all, I think that could play out. But we have to break 260 first. So again, to be really clear here, as long as we hold above 260 on Tesla, I think you stay long. We are just below the 10-day moving average, however, and have been for the last, 6 trading sessions. So that's something to be concerned about. But we're holding 260 so far. So we hold there, stay long. If we break 260, I think you want to get out for the short term because you might see 220 forward. They've made a big foray into EV, and in their earnings report, they talked about how they've actually been a little bit disappointed in how many people have embraced at least Ford's version of the EV cars. So they were kind of disappointed on their numbers. We had a pretty big run up into the earnings report. And you can see even with this downward move into earnings, we still broke down after earnings. Now, the positive here, if you're long Ford, and this is just really going back old school for me, but a few people have been asking about it in recent weeks. So they had earnings. I wanted to bring it up. We are at 13, which is a level that should hold for support. So it's going to try to hold this 13 level. There's the 10-day moving average way up here, just under 14, as you can see right there. And that means that we are a little bit oversold here. So we're a little oversold on Ford. We're right in an area that should hold us support. So perhaps we get a bit of a bounce back to the upside next week on Ford. Now, if we break 13, it's yikes, watch out below because the consolidation and the support is all the way down here just above 11. So we need to hold that level. Note how when we move from just above 11 to 13, it was pretty vertical. So that means there's nothing in the way to stop it. It's like a vacuum here. So if we were to break 13, we're probably coming a lot lower on Ford. But right now we're oversold. And let's see if we can hold this support level, bounce back to the upside. Google just powers on. Now all the rest of the tech stocks are like they're all going to gang up on them, right? Because Google's so far ahead on the AI stuff, etc. And so they're all trying to play catch up. Now the issue here is that we got this gap up. Now I was pretty impressed with the move in Google today because with the gap up on earnings, you can see there's the earnings. So we gapped up. Normally when you gap above a resistance level, and this previous 3 would be considered a resistance level, when you gap up through one of those levels, the move tends to not hold. So I wouldn't have been surprised to have some give back. I don't necessarily think we have to come back and fill this gap now. but I wouldn't have been surprised to see us break back down a little bit. But we powered higher again today. So yesterday, is that it? Just a little bit of give back? I still think you want to be a little suspect. Now, the Wave algorithm likes this 140 price level, so we could continue. You can stay overbought, oversold for short periods of time. We could continue up to 140, but if we do, then I would think it would be a time to look at taking some profits on Google. Now, if we break down first, that could be an entry or a position opportunity to add to a position that you may have already. So just a little bit concerned about the fact that we've gapped up. We're well above the 10-day moving average. So with a gap up above resistance and we're overbought from the 10-day moving average, I think some caution here on Google, and let's let it tell us whether we're going to run to 140 first or back off first and then make a move to 140. And then last but not least, Meta, and man, they are back in favor with all the analysts. It wasn't that long ago that we had Meta way down here below 100 back in November of last year. That seems like a lifetime ago now, doesn't it? Because now we're back above 300, above 320, and we have the exact same scenario here that we just talked about in Google. A gap up above the recent area of resistance right here. We're still in a wave 3 here, though, on Meta, so it just moved the 3 over. But I don't like gapping up through a resistance area and being overbought from the 10-day moving average here as well. But the fact that they've gotten away from talking about the metaverse as much and focus more on their core subscribers, etc., the analysts are giving them some love, raising numbers, etc., and the numbers have come in pretty strongly on Meta. So that's a very nice run. If you want to see what an ideal uptrend looks like, that's it. I love the 45-degree angles because those moves, when you have a 45-degree angle in the trend, you always have impulses and corrections, right? That's the crux of Elliott wave, is measuring impulses and corrections. But when the trend is at a 45-degree angle, the corrections tend to be less severe, and the trend tends to hold a little bit more. And that's exactly what's happened with Meta. So really good looking chart. Are we a little tired here? Let's look at the DMI here on Meta, and you can see the same type of scenario here. We're kind of showing that we're getting tired. The last part of the move here is giving us a little bit of a give back here on the ADX. So at some point in time, we're going to create wave 4s out of all these wave 3s to the upside. So the moves have been strong. They're getting a little tired at this point in time, and we need to watch interest rates. So next week is going to be really, really important to see how we get through. We still have 2 biggies next week, so join us next weekend as well for the market update, because we got Amazon and Apple next week, so they'll tell us a lot as well. So thanks for your attention, your time as always. We really appreciate it. I hope you have a great weekend. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.